Hi, everyone. I'm Christopher Thornycroft with Redwood Logistics, and welcome to the Redwood Rundown for the week of, first week of February. This sucks. We are now seeing the OTRI drop below 5% for the first time in 13 days. This is a sign that the market is weakening a little bit. That February low volume, that end of January push has come and gone. Although we did see the OTVI start to peak up again today for the first time. So that's starting to come back on up. So if that rises, then we'll see the OTRI rising. But until that rises, you see that low volume environment. We're starting to get a feel for where capacity gets balanced and imbalanced right now. Really, when we see that OTVI above 11,000, we're starting to see capacity really shrink. When we see OTVI drop below that, then we're starting to see capacity open on up. One of the places that we're seeing capacity open up a lot is in the Midwest, particularly the Chicago markets, but also all the surrounding markets. Now that we're out of the thaw, we would anticipate that those markets will continue to open on up until we get to the end of the quarter. When we get to the end of the quarter, things will tighten a little bit. Why? Because we're likely to see a little bit more of a volume push. And again, it's a really close alignment between supply and demand. As a matter of fact, if you took a look at the U.S. Bank report on Q4, what they reported was that shipments dropped, but that freight expenditures did not drop anywhere near the same rate as shipments dropping. So they suggest that we have actually gotten to the bottom and are probably now moving past that as far as keeping an eye on that relationship between shipment volume and expenditures. Because what's supposed to happen is if shipment volumes drop off significantly, then you should see freight expenditures drop off significantly. But because of some just-in-time needs for demand caused by some lean inventories, etc., not to mention just general seasonality, etc., we saw actually freight expenditures hold the line a little bit more. That would indicate that freight expenditures are going to continue to go on up. It doesn't matter really who you talk to, whether you're talking to some jerk in Chicago like myself, if you're following the Logistics Manager Index, if you're following the U.S. Bank, if you're looking at year-over-year comps as far as rates go, almost every indication out there says that rates are going on up. And why are rates going on up? Because if you have demand increasing and you have capacity decreasing, that's going to cause rates to go on up. Does it mean that there's a market flip? No, not necessarily, not at all. It just means that gradually we will see price and cost of transportation continue to increase. I made some phone calls to some carriers myself yesterday, talking to some of those old carriers I used to work with, and they all came back with the same thing. They said, Christopher, we cannot continue to operate at these costs. We are raising our prices even if that means we don't get the loads. So there's pushback that's happening. Watch for it. Be aware of it. Don't think that you're getting those Q2 rate reductions coming your way, because chances are the carriers that you're working with cannot support those rates. That's what we've got. We'll talk to you soon. Oh, happy Super Bowl. Enjoy yourselves. Take care.